Why do investors need to know about this? A little bit about asset allocation and timing the market, and then the sectoral trends. So, again, welcome all to be with us here on a Saturday morning, a nice Saturday morning. And I must take this opportunity to appreciate the people behind all this effort, because I have been a member of other societies, and I was a member of the New York Society of Security Analysts for a long time, and I must say the events here are much better organized than there, and I shouldn't compare, they have their own strengths, but this, Delhi society does very well in organizing the events. Everything is very efficient and swift. Materials are available very promptly. There are no hiccups. And I was very pleasantly surprised to see all this. And I'm sure the other Indian societies are doing well on that regard, but must congratulate Vidhi, Jesse, Gaurav, and the others behind this effort. And without further ado, I will get started. So over to you, sir.
Good morning, everyone. I think I'm audible enough? Yeah. All right. So before we start on technical analysis, what do you all think about technical analysis? Right? There are a lot of myths about technical analysis. So anything on technical analysis? On the opposite side of it, why it doesn't work or why it is crappy?
Study of past prices and volumes.
No, I'm saying something wrong about technical analysis which you need to say. This doesn't work. This is all crap.
It fails more often.
Absolutely.
We cannot generate an alpha by investing.
All right, so we'll see that. That is one of the topics during the session.
Different time frames give a different story.
Absolutely. So it happens with quarterly results also, right?
Nooresh, you can repeat what they're saying in this.
So, so somebody said alpha cannot be made via technical analysis. Somebody said different time frames give different conclusions.
There is too much noise or too much focus on price movement rather than the business itself.
Absolutely. So that is the job. So the job is to look at price and volumes. So see, the reason I talk about technical analysis is something, so this is something which we have started noticing. Yeah. So we'll try to, I'll maybe in an hour try to make it easier. Right. So technical analysis is something which is very old, right? But the fact is, we've started accepting it very recently, right? So some of the oldest, say, material written on technical analysis goes back 100 years. So it was written by Mr. Charles Dow, and that's how you have Dow Jones Index. So he's the founder of the Dow Jones Index, you can call it. So let me go to the topic itself, right? So these are the 4 topics I'll try to cover today. The first part, timing the market versus time in the market. And if you are into the asset management industry, you should never say time the market. All right. Then we look at sectoral analysis. So these are the 4 things. So next is increasing cash, when to increase cash, and investing in panics. So basically, if we can cover these 4 points, it takes care of what an investor need to take out of technical analysis. All right. So the first part is to accept whether timing is important or not. All right. Otherwise, we are making no attempts, right? Technical analysis is all about timing. Timing the entries, timing the exits, right? Sectoral analysis leadership. Now, this is something where you can always add up fundamentals to it. Now, the basic difference between technical analysis and fundamental analysis is, in fundamental analysis, you keep on asking the question why. Why will the earnings go up? Why will the company do better, right? But when you come to technical analysis, you don't ask the question why. You ask the question what. What is the price saying? What is the volume saying? What is the data in front of me? All right, so you can say, you all look at price to earnings. We look at perception to equity. Right? And that perception keeps changing with market conditions. So that is the gauge we are trying to take. Right? So why is timing the market important or not? So I won't go into CAGR or what happened in the market. I'll take a very simple desi calculation. How much time does it take to double your money when you go wrong on timing? All right. So consider you bought right at the top of 2007 or 2004 or the previous peaks, right, or pre-COVID. So if you bought in 2007, roughly, it took you another 14 years to double your money. If you can go back, Nifty was 6,300 back then. When did we come back to 12,000? Only after 2016-17, right? So how long does it take? Really wrong if you screw up. And that is the point of thing which you should not mention if you are in an AMC. What you should mention? The long-term return of India is 15% CAGR, which is not. I'll tell you why. The mutual fund started in 1992, 1994. The data starts from 1979 for the Sensex. But the Sensex got started in 1987. So the first few years of data itself is wrong. And if you take any point of time from the 1990s, it's very difficult to go to that 15-17% CAGR. Right? So it's like saying my father did really well, so I am very smart. And I will also do very, very well. So basically, the Indian equity return is much lower than what we think. So you can go back, look into this data point, and that's why we use data from 1979. It started with a base of 100 Sensex. And in our lifetimes, it's not going to happen. Between 100 to 1992, it was at 4,500. Do you think you'll get a 45xer on Nifty anytime in your careers? Right? 4.5x also looks difficult. So that's how the return comes up. And that's why timing is important. But timing does not imply you have to go 100% in and 100% out. Because that is what it theoretically means. Right? If you go wrong, you sold everything in COVID, thinking it will go much more worse. You're done. Right? So these are the various time frames. And consider the opposite side of it, buying at the bottom. Right? You end up doubling your money in 2, 3, 7 years. COVID is a classic example. 7,500 to 14,000 happen in less than 2 years. Right? 15,000 rather. All right. So, why timing the market is important? Because if you invested in 2007, for a period of a decade almost, you did not beat FD returns. Right? So, what I mean to say by timing the market is, this is what theory means. Getting out 100%, getting in 100%. Right? So that's why we say do not time the market. Time in the market is more important. But if you notice, how many years does it take to get back if you have come right at the top? How long is long term? Right? 1992, 4,500 Sensex did not come back up till 2005. 13 years. So basically we can say 14 साल का वनवास हो सकता है गलत हुए तो. All right. So nobody can catch the top and the bottom. Right? So all you need, what we are trying to do is just be reasonably right than to be exactly right. And do not be unreasonable with your cash allocations. So I'm not saying you have to go to 50% cash, 80% cash. You find your comfort between 10 to 40% cash and 10 to 40% extra deployment when everything is, what do you call, blood on the streets, which is ours only all the time. Right? You can't lick your own blood easily. We are not vampires. But that is the way it is. It's very difficult. It's easy to say, okay, buy when others are scared, etc. But easier said than done. All right. In the last, so I've been in the markets for like now 18 years. The only best opportunity wherein everyone could buy came in COVID. Where everyone had time, everyone had money, and more importantly, access. Right? You did not need to make 42 signatures anymore to open an account. So thanks to Digital India, one of the only times where retail money came into the markets right at the bottom. So what we'll try to do is, but the real part is not of cashing out. See, because when you cash out, what is the maximum fall we've got? 20 to 60%. So essentially you are making a trade for 20 to 60% when you sell and get in. But the real outperformance comes when the money is deployed. When you actually end up loading a lot more at the right times. So if you bought in COVID, right at the bottom, say between 10,000 to 7,500 Nifty, your sorted outperformance is going to stay for a really long time. Because on the upside, markets can go multiple times over a period of time. On the downside, it's been only 60% down. So this is what we'll try to do. Look at, so very simple example, if you end up doing this, 10% cash over a few cycles, you'll end up outperforming by a big margin. And you don't need to be right at the top, 10% lower from the top, 10% higher from the bottom. So we'll try to see examples how we can do this. Now, yeah.
If I may. So when would you do 10 to 40% itself is a big range?
Yeah.
So when would you, is it like when or who?
So 10 to 40% is the personal comfort, right? Because it's very difficult to take a 40% cash call. And what happens is once you take the cash call, it is much more difficult to get back in, right? So you have to find your comfort. So that's why I give a range. So I know some people, for them 10% is too much cash call taken. For some, it can be 40%. Yeah, so it is a personal range, right? So I'll give you some parameters where you can do it. You find your personal comfort on it. Because everyone has a different temperament. So then somebody spoke about alpha, right? The fact is, there is no alpha really. Everyone goes through cycles just like markets. So every fund manager has a hot streak. Every fund manager has a bad streak. And by the time you will realize he is good, it should at least take you 10, 15 years, a couple of cycles. But I'll give you a very nice example as to why, if your timing is a little bit right, alpha comes very normally from the markets. So people say there are various logics used. We do a lot of analysis. So I run a random portfolio test. And it humbles you down in a big way. To give you an example, so a random portfolio is very simple, 25 stocks, 4% weightage each. Right? So no universe, no market cap, only NSE stocks to remove the BSE universe of bad companies, which are only on BSE. So you can beat the index, but can you beat the random portfolio? So we just took, this is a recent data. So if you bought pre-COVID or in Jan 18, right at the top of 2018 bull market end, then at the bottom, then we made another new high in November 20. And say this was done at November 21. Look at the random portfolio returns. I would want you to look before I start talking on it. The two time frames, 2018 to 2021, and consider you missed out the entire COVID up and down, and you came back again when we were at 12,400 Nifty, right? So why it's never too late in the trend also. So between 2020 November, this is the Nifty peak. This is first 2018 fall, then 2020 fall, till November 21. What is the Nifty return? Right? So this was the only period of time between 2018 to 21 where the random portfolio came very close to the return of Nifty. But this is the more interesting part, which I talk about. If you bought at November 20, missed out the entire fall, you were scared, and you only bought at a new high. what would your returns be in a year? This part. What is the Nifty return? So 2018 Nifty was at somewhere closer to 11,700 when the market stopped. By the end of 2020, before COVID, Nifty was at 12,400. But the small cap indices were already down between 30 to 45%. All right. So when you bought in 2020, even at a new all-time high on Nifty, the small cap and the mid cap indices were still down 30%, 35%, roughly 25 to 30%. So the next 1 year, this is what happened. So you could double your money in the next 1 year by a random portfolio which is diversified, 4% weight each. So it's not concentrated. There is no selection. It's just rand function on Excel sheet. All right. So that's the reason when you talk about timing the market. All right. So when do you put money makes a big difference. Even at 12,400, you have huge amount of returns left. And since then we've been saying market valuations are expensive. So very recently, now we've seen a correction which a lot of people call it a bear market, right? We topped out at 18,600, went to 15,200. We called it a bear market. We are still below 18,600. We are at 17,500, 600 roughly over a period of last couple of weeks. Can you see what is the random portfolio return? How many of y'all have actually beaten this return? Last 1 year return? Right? Because what happens is, when there is Ukraine, when there is something else happening, instead of buying, we end up selling or doing nothing. All right. So these are the kind of returns which have happened. So that's why I say, why do we need to add technical analysis or various things to our arsenal? Right? If you know when to deploy good amount of your money, your returns can be way, way different. So we focus a lot more on stock selection. Right? But not on allocation of cash at the right times or asset allocation. Right? All of us are always discussing क्या लेना है, क्या बेचना है, कौन सा महंगा है, कौन सा सस्ता है, what is happening, right? But the reality is, with a 25 stock portfolio of 4% weight each, right, it beats all of us. So generally what I do is, whenever I have a great run in the markets, I run a random portfolio test. And suddenly, it either humbles you or humiliates you. When you underperform by a big margin to the random portfolio, it is seriously irritating, right? So whenever I do this test, I send it across to all my investor friends. So they are like, boss, why are you screwing our happiness? I had a fabulous year, outperformed the indices by a big margin, money is rolling in, and you send me this. Problem kya hai tera? All right. So, because after a great year, we all feel we are the best investors. All right. So basically, it would be rare for you to underperform randomly also, if your timing is roughly right. So let us look at what to do. Now, how can you beat the random portfolio then? If you can deploy or redeploy cash, right? Or you have concentration, right? That portfolio has 4% weight each. So you have a 10% allocation, goes up 10x, it beats everything. All right. So this was the only learning which I have come out with. How do you outperform the markets? Either you have to be concentrated, And you can look back to the history of everyone who's gone right. They have been concentrated investors. But if you're not taking the effort, how can you be concentrated? All right. So, now we'll look at what we do for timing. So now there are three parts which we look at. First is sectoral leadership. Now, when I talk about sectoral leadership, it helps you in two times. One in a bull market and one in a sideways market. Because bear market mein there is no leadership. Everyone falls. 2008 there was no sector which was up. All right. So and something falling 45%, something falling 60% does not make a big difference to you because both have fallen. But it works brilliantly in a sideways market, like 2011 to 13, 2015 to 16, say 2021 to 22 this year. The Nifty has been sideways, but if your sectors were right, you would outperform by a big, big margin. So how do we look at sectoral leadership? So first we keep tracking what? There are sectoral indices on NSE, BSE. But the problem is when you look at sectoral indices, they are too skewed towards the top names, right? Even the Nifty today, you can say if you have a Nifty ETF, you have a very concentrated portfolio. Because single stock is 12 to 14% Reliance Industries. Then HDFC Group, which will eventually be a single listed company, is 15, 17%. So you have three stocks with 25, 28% weight. All right. And that is one more reason you will not see much bigger falls of late, which you don't see anymore. Why PE bands have shifted higher? Because the structure has changed. Back in 2007, Unitech had a higher weightage than HDFC. Arcom was the 6th or 7th largest weight on the index. The second one was ONGC. 2009, the index became free float market cap. Since then, 16-18% banking and financial ended up becoming 35 to 40%. All right, so the structure of your benchmark is also changing by a big margin, right? So in the same way, when we look at a pharma index, we suddenly realize the largest weight is Sun Pharma. Because earlier there were a lot of PSU companies, ONGC was the second largest weight, right? So PSUs have never got 40 PEs, right? But your IT, banking, all the weights which went up have, and there are more stabler businesses today. So you can call HDFC Bank good or bad, but you can't call it ugly. All right. So then when we look at sectors, the problem is we don't have many sectoral indices. And if you have, like Bank Nifty, you'll have 35% weight to HDFC Bank. All right. But you have a PSU bank index. But when you go to sectors like chemicals, textiles, sugars, paper, you don't have a sectoral index. So that is where we need to make our own. So how do we keep tracking for what is leading? So we keep looking out for 52-week highs, 1-month highs, 3-month highs to get a clue. Because what we are trying to understand from sectoral leadership is what is the relative outperformer to the index. That's how we look at it. All right, okay, what is doing better than the Nifty? No, so we are not just because it's coming on a 52-week high we are buying. Because we have what? Sectoral discrepancies, we don't have indices, so we don't have a sugar index, right? So how do you, either you have to make your own index and continue to maintain it, or what do you do? Look at 1-month, 3-month high. Suddenly you see 1-month high, they're all sugar names. So then you go back and look at 20 sugar charts, right? Something has to initiate relative outperformance because we can't be doing a relative outperformance for 1500 stocks all the time or 10-15 sectors which do not have an index. So there are three ways you can look at it when I talk about relative strength. First is a comparative analysis, wherein what we do is we take the Nifty chart on the bottom, take the other index chart on the top, just by having a visual look. The second method is you use a ratio chart. Basically, you divide, say, Bank Nifty divided by Nifty. All right. 38,000 divided by 17,500. So you'll get a ratio. Right? If the ratio is increasing, implies Bank Nifty is doing better. And the last one is a little difficult one. It's a technical one where you have to create your own indices to track. So we create equivate indices of many sectors to keep a track of. So let me take you through an example. So the chart above in blue is Nifty. The bottom one is the FMCG index, right? Can you see something out here? This is where Nifty tops out. This is your FMCG. Did come back to the same prices in 2007. Everything fell by 2008. What is interesting in 2009-10? Has Nifty made a new all-time high? But FMCG has. So that's a very strong indication. Whenever the market is sideways, the sector which breaks out the first tends to outperform over the next 2-3 years. We'll see examples of some recent times also. I'm taking a little older example also. And then what happens by the end of the cycle, right? Then again in 2010, has this made a new high? But your FMCG index makes a new high. What happens to FMCG index between 2010 to 2013? Goes up 2.5 times. And by end of it, ITC is the largest weight on Nifty with a weightage of 10%. FII ownership in ITC in 2013 to 15 is 20.8% of the shareholding. Cut to 2020, it becomes a meme stock. Goes nowhere for a decade. What happens in that period? FII shareholding goes down from 20.8% to 10%. Finally, December 21, it changes to 10 to 11%, and the whole thing rolls on again. Right? Then it goes from 200 to 330 today. But what happens? By the time everyone started believing in FMCG, FMCG was done in 2013. And it took 10 years for it to come back also. Get back some sort of respect in terms of weightage in the Nifty, not our respect. All right. So it became and this is a period of time where between 2010 to 2013, what happened to the Nifty? 6,300 in 2010, 6,300 in 2014. Now imagine you have a period of time where your index has gone sideways and you hold some allocation to a sector which has gone up 2.5 times. All right. Another example. Cut to 2012. The Nifty is still making what? Lower tops and lower bottoms. It is still lower. What happens to pharma? Makes a new high. This one. You can pick it up here also, here also. What you are trying to see is कि leadership कहाँ पे है? Because some of the stocks would have already broken out in the index. Yeah. Yeah, so that is where you start off. But the point is, outperformance is where we start buying into it. Like I said, falling lesser does not help. We want to make a return. All right.
This chart is from 2012.
Yes.
Roughly you take 10-year chart, is it?
No, this is 2010 to 2012. Right. What happened to? Yeah, minimum. Like if you don't like a chart for 6 to 18 months, it's very difficult to like it for a 6-year period also. All right. So what happens between 2012 to 2015? Pharma index goes up 2.5 times. And by end of it, we are doing what? This company has so many ANDA filings. समझता सबको अंडा ही है फार्मा का, इतना प्रमोटर को भी नहीं समझता है, right? Because it's one of the difficult sectors. So what was market doing up? This company has this many filings, this company has this, generics, array, Indian generics are the best, right? This all started getting discussed in 2015. Up till 2012, 2010, 2012, whatever pharma and IT, pharma and FMCG, I remember when I got into the markets in 2004, the saying was, ITC, HUL are for retired people. Those who have got IPO allotments back in the 80s. They are defensives. Defensives ka matlab, Hindi matlab ye, they don't go up more than 25% in a year. Right? So they were called defensives, made the most aggressive moves between 2010, 12 and 15 when the index went nowhere. All right. So that is what we are trying to do. Suppose you have a 10% allocation, more than what is there in any of the benchmarks to one of these sectors. Your outperformance will be beyond. And this is what made a few fund managers, few PMS managers betting on such trends. Now, so this is what happened with pharma. Can you see the rally? So the initial part it outperforms, then the market goes up, pharma continues to go up. Sun Pharma topped out at 1100 roughly in 2015. Where is it today? 7.5 ho gayi hai. 7 years are done. Right? So when the trends, so then the trends will start with what? Larger companies. End up with what? So it will start from Sun Pharma, end up with Marksans Pharma. The best performing stock in 2015 was Marksans Pharma. So all the trends will start with larger names, end with the worst names. So the next example which I have not put up here is in this period. Remember 2015 to 16? Nifty went down from 9,000 to 7,000 roughly. That is the time where chemicals and textiles came into focus. Right? Chemicals were doing well 2014-15. 2015-16 it ended a superb year. Right? What happened by end of 2018? This was a sector which was called commodity. Right? What happens by 2018? Specialty chemicals. Companies started changing their names to specialty chemicals. Somebody made it specialty chemicals, somebody made it specialty food ingredients, etc. Right? So by the time realization comes, your Atul has become a multi-bagger, Deepak Nitrite has become a multi-bagger, various fluorine companies, etc. But you could see it in 2015-16, when the Nifty was down, there were 2-3 sectors which were making new all-time highs. Right? And then by end of it, we also called it China plus one. So when do you know the trend has been accepted? When there are new acronyms given. All right. Where we started looking at ANDA filings. Then we started valuing ITC ka hotel business to paper business back in 2013. Right? So this is the way it plays out. You will catch it on the charts first, but there will be zero belief. Why? Because for 10 years, 2002 to 2012, you've heard what? FMCG is defensive. Hindustan Unilever return is 0 for 10 years between 2002 to 2012. Very difficult to then say, boss, this 270 rupees stock, where the company has come out with a buyback also, will end up becoming 600 in the next 2 years. Because your past history is terrible. So it is very easy to look at technicals, but if you ask the question why, you're gone. Classic example, BPCL breaks out in 2014. Crude, it goes up 50-100%. Crude is still at 105. Right, so we have this correlation. Crude has to come down for BPCL to go up. A year later, diesel deregulation. So the markets are very smart. So that is what we technical analysts assume. We are dumb. Market people are smart. We are just going to piggyback. Somebody has taken that effort. Classic example, we all are here today. There is a recording which will go on YouTube. Because of Jio, 2008 to 2017, Reliance was what? Zero return. The day Jio plans got launched, the next day it was up 10% with 10x volumes. And it was the best performing stock for the next 3 years. But in 2017, what was our belief? Because of previous price action, big money is only made in small caps. Large money is not made in large caps. So which was the best performing stock? The largest company of India in that year. All right. So this is where a little bit of a dissonance will happen when you're looking at technicals. Because what it is pointing to is very contrary to your previous 2, 5, 10 years. And there is no real answer for the why. Right? Could you have said Jio will go so huge in the next 3 years? If yes, you should have bought Reliance without any of this. All right. But somebody thought so, somebody bought so, and we also bought. That is the way we work. Till the time it makes higher tops and higher bottoms. Simple Dow theory 100 years back. The same thing should continue. 100 to 120, then 110, then 150, 130. This should continue. The day it stops, you change. There is a classic example, it will answer you. The next slide will answer it. Now this is Nifty IT. Another defensive?
Adding to the Jio story, during the pandemic period, Reliance wrote off a lot of debt with joint ventures and
But between 2017 to 20 itself, it was a big bagger. Right? So new stories keep coming up. See, when a trend starts, right? So it was only Jio, then it became a platform, then it will become something else. So that's why I said, when you are going initially, there are not many reasons. The reasons do come up. Right? Now, this is another defensive, which has been called defensive for the last few years, before COVID. Right? We used to have this thing every time. USD INR has gone up, IT should act as a defensive. Right? You keep listening to it every few months. All right. What happens in 2020? The first sector to cross the pre-COVID highs, IT. And this is a ratio chart now. So earlier we saw Nifty and the Nifty IT index. Now we look at the ratio chart. So this ratio chart, so every time it came in line with the Nifty, it would flop out. For 10 years, so this chart was very similar for 10 years. So Nifty IT was always a inline performer, never an outperformer. But something changed here in 2020. The first part, it did not fall as much as the markets did, but that is not what it helps. That is the price point where you realize that there is some sort of outperformance here. But that does not make you money. What makes you money is when it starts taking actual leadership. What happens over the next? Has this index also doubled up? You're not buying in COVID, you're not buying here, you're buying at a new high, which is around 18,000, it goes to what, 40,000? Now can you see the similarity of pharma and FMCG of 2012, chemicals of 2015-16, then 2020, IT and pharma again. Right, can you see higher tops and higher bottom continues? When is it changing? Right, so this was start of the year.
again there is a fundamental reason.
There are always a reason, right? Somebody is betting on that reason and we are just piggybacking. That's the whole point. All right. But the point is, I can give you 10 reasons that 5% of their sales used to come from foreign expenses. The EPS should bump up by 25%. Right? Yeah. But I'm saying, doesn't matter IT services. 5% of their cost was travel, right? That stopped. You have a 20-25% bump up on the earnings. Right? Like I said, we love to do post-mortem. Right? In the markets, we are always in post-mortem mode. But, yeah. We don't know, it can continue for a much longer time. So let the prices tell you. So out here, see what is happening. Finally, this structure is broken. Out here, you have a newer low, right? So what does it tell you? The trend has changed, right? Where is this now? Somewhere here. Post that, Nifty IT has corrected a good 20%, right? So this is how you play the trend and you get out of the trend. See, out here also it did not break the lows in between.
By this logic, if you look at commodities, they were also this kind of parabolic.
It's coming next.
Jumped in, and there were macro events which
Again post-mortem. We'll take the chart.
talk about how you
Metals is next.
how you do a risk calculation on this. That how this curve is, how risky it is, what kind of risk parameters.
So we'll take the metals ka chart. It's coming next.
But for IT services, it's not a post-mortem. It could be seen that the demand for the IT services will go up.
Yes.
Zoom price of Zoom shares,
Where is Zoom today?
that is a
Right. See, the whole point is, like I said, at that point of time, right, none of the Indian companies are closer to Zoom, right? We are not product companies. I'm an IT guy, so I'm an IT engineer by qualification. So half my friends are from the IT domain, or rather more than half. Yeah. Can you just see this? This is pre-COVID. How many sectors were above pre-COVID highs in June 2020? None. Pharma and IT. This is a ratio chart. Nifty IT divided by Nifty index, right? So basically what you're doing, say Bank Nifty is at 40,000, Nifty is at 20,000. The ratio is 2. Suddenly it becomes 2.2 implies what? Bank Nifty has done better, right? That's the simplest calculation.
I'm not sure if this is the latest chart, but assuming it is back to 27 or somewhere, where is your Nifty IT ratio chart as of now? Is it hitting that green line again?
Back here.
Is it there already?
Back here. The whole outperformance is now become in line.
Right, so 50% down already from
It's down 32% from the top, Nifty IT index.
okay, yeah, 30 to 40, so is it time to buy?
So I don't want to give a recommendation, but that has been my view. So that's my public view. Okay, so I was very bearish for the last 6 months. I'm no more bearish. So it's a publicly mentioned view.
So do you see newer highs?
No. So it will be back to that inline performer. Yeah.
Could you give more clarity on how to exit? Because do you also use moving averages or?
Lower tops. So the last out here, like I said, see what is this? This is the last bottom. This has broken here, then broken here. So this is a chart up till March 22. So somewhere here you have to exit.
So how many candles do you wait for? Or because in the middle also I see there are 2 candles where we are seeing a
So just a weekly close. All right, and one more thing is what? The outperformance period is done. So the index will break down a little later. A lot of stocks were already breaking down. Right? So a similar price point for majority of the mid-cap IT was already broken. Because TCS, Infosys have a larger weight, they had fallen lesser. But your Mindtrees and LTTS had already broken down by a big margin. That's why I said, okay, when you look at sectoral charts, you have to go further also. Because there is a lot of skew towards the top weights.
Can we do for stock selection? Can we do the same ratio chart and comparative analysis?
Not necessary.
So how to go in a particular sector?
That's a different topic altogether. We'll take it off after this session. Now look at another example. This is the pharma index. Can you see a similarity? This is the pre-COVID price. Crosses pre-COVID highs. First, this ratio charts crosses pre-COVID because it falls a little lesser. But when is money made? When you get this also confirmation. You just don't buy on ratio improving. You buy on prices also improving. What has happened here? First sector to again cross pre-COVID highs. See, June, July is when IT and pharma crossed pre-COVID highs. Nifty crossed it in November 20. All right. And this is what happens. Again, this is almost up 80% in that period of time. The index itself. See, when I talk about the index, the stocks would be up much more. Because here, which was the largest weight? Sun Pharma, which did nothing.
So again, there is a reason.
There is always a reason, sir. So I say very simple, no, I said it.
How to relate the technicals with fundamentals?
That's why I said you find the reasons, no, that's why I said okay, when it happens, you go and look at are the fundamentals aligning with it. Many a times they don't. They start happening a little later. Right? So it's very simple. Businesses, there are some amazing people running the businesses. Right? That's why prices are doing well. Prices are doing well, so we are also getting in. So we are the dumbest. That is why I said no.
So prices are doing well because medicines would go up.
Like,
Pandemic period.
right.
And that is very logical.
So that is very logical. Look at the largest producer of ibuprofen in India. The stock topped out really soon. By the time you realized it.
I see three lows, low bottoms in the middle. Further up. This one, yeah. So you have three lower.
Nee, can you see there? They've not broken it. It starts here. This is the first time. And this is the time you get out.
But if I'm sitting at that lower, you will see the ratio is also falling.
Yeah. So see, what will initially happen? Outperformance. But it's still better than where it was, no? Because see, if the ratio is just falling, it is mildly underperforming the Nifty. Right?
But assuming like I don't know what the future is and I'm sitting today at the lower side, like at that point where it is.
So see, at this point, say consider at this point, this low would break. You exit.
But like definitely we don't have this much of clarity when we are actually analyzing anything. So let's say my benchmark where you are pointing at the ratio, at the down, where it is the circle. So this is my benchmark, no? Where the circle is.
So this is where you enter. See, the rule is very simple. You enter on the breakout and then continue till the time there are higher tops and higher bottoms. The ratio chart does not matter after that. All right? Because there will be small phases where it will underperform, right, for a 3-month period. Right? Chemicals have not done every quarter up from 2015 to 18, right? There were a couple of quarters where they underperformed the Nifty by a small margin. See, the whole point is, what we are trying to understand is a very simple part, higher tops and higher bottoms, which was written 120 years ago. All right. Now look at another example, metals. Right? So the prices break out, the ratio chart breaks out after a really long time, metals start outperforming the Nifty. Very interesting, Nifty is at 15,300. You say metals is a very high beta sector. So when the Nifty goes down, you should not buy high beta. Barabar? Right? What happens to metals? In March 21, the index doubles up. Can you see the doubling? Right? Doubling up calculations are easy. That's why I use that. Right? So, it goes contrary to your normal thinking process. By end of it, what happens? Everyone starts talking about at 70,000 steel price, this is the kind of profits that we'll make. We start calculating PE for sale. Right? Then we say $3,800, 3,800 ho gaya LME aluminium. Right? We are looking at nickel prices, the short squeeze in nickel. So we'll see similarities in every cycle I'm talking about. By end of it, what happens? People are actually saying this is so cheap, P is 2, 3, 4. Right? Now what was happening? See, this is clear cut, higher tops and higher bottoms. What is happening here? All right. This is this is a chart which I made for a presentation at that point of time. Okay, this is where you are exiting. And then in the next few weeks it happened. You know now where is metals today, right? Back to the same prices. So you wrote this trend. See, you still, after this is 2500, this exit is at 5000. I'm not talking about the top. Your exit is at double. All right. So then we did something interesting with it, which is sort of reasoning. What is better for autos? Metal prices going down. So we did a ratio chart with Nifty auto with Nifty metals. It was dead in the dumps. But Nifty auto was breaking out. This is somewhere 3-6 months back. So this is what happened after that. All right. So the last way to look at sectoral leadership is something which is a little difficult to create your own equivalent indices. So I'll just rush through it because there is an effort to do that. But I'll give you what happens. Just the skew part, right? So above is the Nifty Pharma Index. Below is the Nifty Pharma Equivate. Can you see the difference? How different both the charts are, right? Dono pharma hai. But what is this? So this is an equivate chart of these companies. So this is the next chart. This was one more. This is a little zoomed up chart. This is Nifty Pharma ka hi equivates, right? The Nifty Pharma Index equivates because Sun Pharma and Dr. Reddy had the largest weights in the pharma index. Sun Pharma 7 years no return, but a lot of other pharma companies were doing amazing. But because your 25% to 40% is in these two names, it is not seen on the Nifty Pharma Index. What is actually happening in 2020? This is breaking into all-time highs, the equivate. Next one, larger companies, greater than 10K crore market cap, equivate index, all-time highs. And this did not fall only in this period. Right? Some. Huh? So let me not give recommendations, and I'll have to give all disclosures of SEBI, etc. Right? So we can take it off record. I'm a very transparent person otherwise. Right? So another quick example.
All this is in hindsight, right? Where are you actually following the equivates and where you follow the actual index?
So this is the next one. So these are all, so this is something, so all what I do is there on the internet. All right. So if I talk about banks today, my report dated for 24th June 2022 is there on the website to be seen. All right. So there is no post-mortem.
And I'm just asking, is it something that you religiously follow? That
Yes.
for pharma, it's always equivalent.
Yes.
And for banking, it's the index.
No. So even in banks, we will make a equivalent banking. So we keep doing this. See, something has to be done also for us also. No? Matlab, we also should make a little more effort, right? In work you are doing.
And sorry, another suggestion, or we have seen something similar called a patented relative rotation graph.
Those are complicated.
But it's a combined view of everything what you're doing.
That's why I said, no, I don't want to get the khichdi inside. No? I just want to understand two indices. RRGs are very complicated because you take all the 15 index in it. If I show a RRG to you, you'll be like, kya hai? Right? That's why I said, my job is to first get it right and make it simple also for my clients. Right? Now this is an example of a equivate power index, which we looked at in last year, in April 21. We did one nice thing. We removed out Adani Power and Transmission, because that was an outlier. All right. Because it didn't care about the power index. Right? So this was breaking out on a 10-year time frame. Back in 2007, we used to say India is a power deficient country. Now the world is power deficient. Right? And we are power relatively independent. So this broke out in April 21. So there is a report which we came out with. This is the chart. This is the chart then, can you see a similar this thing, which I explained in the previous chart? Equivate index making a new high, tells you something. What happens by end of it? There is a lot of equity inflow in Tata Power, right? We all talk about charging stations will become the next part, which will still remain a very, very small part of Tata Power for a long time. But you have to create that buzz after the stock price has gone from 60 to 250, right? So this is a recent report on Bank Nifty, where we looked at the same thing. Banks were always the leader. The leadership went off in COVID because of all the situation. Then it started changing only in 2022. So this is the chart before and this is after. All right. So next we go to the very interesting part, which is when to increase cash. So see, all these correlations are very good in theory, right? So if you look at it, auto did, escorts went up 10x in the last 5 years. Mahindra was 0. The larger company is what? Mahindra and Mahindra, right? So there will be correlations, the correlations will also break. The whole point is, when we come to technical data, most of the times it is pointing to something breaking, a change happening, right? What are we trying to look at it? The change happening, right? Interest rate hikes, but the bank Nifty did nothing for the last year or so. So when we put it in terms of data, it does not work well. Correlations sound very nice. Try to prove it data, it will not work. All right.
I think you mentioned the fact that PE bands have changed. So back in 2008, constituents of Nifty were different, ONGCs, and that's why today it's much more skewed, concentrated. So I just wanted to know that if we look at sectoral indices, is there a source where we can find what were the constituents of Nifty Pharma back in 2008?
Yeah, niftyindices.com.
Achha, we can go back also.
niftyindices.com monthly reports. Every month weightages are given.
Okay, and so other thing was, I was just doing this thing. There are major 6 sectors having top 5 stocks is 70 to 90%.
So I'll give you whole numbers. It will take a lot of time, but
So the question was how to make equity equal indices, which you
that's why I said, so we make it on Metastock. It's a little bit of code which goes in, right? So that's why I could not take it up, right? It's a very small code, not a very difficult one, right? No, nothing. It's just in Metastock formula language. Very simple one. It's just a copy paste. I can send it to you. Now, we'll end up with a very interesting topic. This is a topic which I love. When to increase cash. All right. And this is the beauty of India because we have an index which can allow us to do it. Right? From the start of our schooling, A division, top 30 students, right? Nifty, top 50, Dow 30, right? All the indices are what? Top 50, top 100, top 200. But we have a beautiful index in India called BSE Small Cap Index, which only denotes the bottom 15% of the market cap, of the total BSE market cap. So the companies which form the absolute bottom, right? So I call it the Kachra Index of India. Because the lowest company, I think market cap would be 10, 20 crores or 40 crores. All right. And it has no limit on number of stocks. So I think as of today, it will still have 850 stocks. Total NSE generally on a daily basis is 1500 to 1700 stocks traded. Right. So this is the absolute Kachra Index of India. So whenever this does really well, you have a problem. So I'll just quickly take it. So what is the problem? A very simple calculation. The Nifty goes up 10%, BSE small cap goes up 30%, matlab locha hai. There is a problem. There is euphoria to another level. Because there are very, very small companies out there with very, very small weights. So some of them would have gone really berserk in that period for the index to go up 30%. See what happens in the normal index, I said, index would be up 100%, there will be stock which are up 300%. Here there could be stocks that are up 10 times, 5 times in a very short period of time. So now this is 2008. So this is Nifty struggling to make a 5-10% move. What has happened to the BSE small cap? Vertical. And from this point, it's almost a vertical ride. Right? So this is madness. So the Nifty is up, say 5-10%, the small cap index is up 30%. And this will continue. So you will get an indication here. This is madness. But it will go much more mad. So this is the point of time. What do? Increase cash. Stop buying absolutely. No new money to be put into the markets. We'll see another easier way to look at it. So this is 2010. Can you see the (2016) lower tops on Nifty, right? You'll see all these periods of time you got a good correction. So basically Nifty going like this or like this and this going vertical implies time to increase cash, right? Going into demonetization. Demonetization was post-mortem, but there was US elections. Can you see what is happening to the Nifty? And what is happening to the BSE small cap? So this period will last for a few weeks to months. So there is enough time for you to increase cash, right? So a huge divergence is something which you don't like in small caps, and the BSE small cap specifically. 2017-18 was not as bad as vertical, but can you see the out here? This is slow. This is, yeah.
So exaggerated moves in small caps, it can be explained, right? That the buying starts late or whatever. But how do they diverge completely, like directionally also? What explains that? And
Nothing. Market madness. Market madness. Euphoria. By end of it, everyone wants to be in small caps.
But in the broader index or the Nifty top 50 is going actually down directionally. Why is there an euphoria? Why would there?
Go back, ask yourself what were you doing in 2017. Reliance was breaking out, doing well, but we are still buying small caps. (10 to 40%). So coming back again is at a 15-20% decline. Start looking at it. More importantly, if you can't go on cash, stop buying in those times. Because the worst mistakes happened in 2017, 2007. Right?
At such point, do we have any sectors which are showing strength? At such points, do we have any sectors?
Showing strength, nothing. You don't want to buy anything. Jo hai so wo hai, and you want to go to cash. Or otherwise the normal thing which we do, buy and hold. At least stop new buying. That itself will be a savior, because at that point the sectors which top do not come back really fast. Right? See, pharma topped in 2015, Sun Pharma 7 years gone. Right? So the problem is what you are buying in those times could be the worst ones a year ahead. Alright. So another way to look at it is again a ratio chart. Divide BSE small cap by Nifty. So this though you can do on your calculators every day. And this ratio can be your good guideline. So whenever it gets closer to 2, it's a problem area. See, because BSE small cap mein kaisa hai, if you have a good outperformer, the market cap shoots up a lot. It will get out of BSE small cap. Right? So the BSE small cap index should not outperform Nifty for a long time. Right? If some Laurus Labs or some Deepak Nitrite was in BSE small cap, it will move out once it becomes 20,000 crores market cap. So again you are back to the kachra. So this index is not supposed to outperform because it keeps taking the worst names again and again. So that's why this ratio works. Right? Essentially top 50 mein kya hoga? The best companies go in. Here moment you become the best, you are kicked out. Right? You become the largest weight, you are kicked out. Because you become part of the other indices.
No, but during that period when it becomes the largest one, that period itself is the outcome.
Yes, I'm saying over a 10-year period, right? What will happen? This index is not supposed to outperform the Nifty by a big margin. Right? See, if there is outperformance, like say bank to Nifty ratio has kept on going up for the last 10, 12 years. This has not gone up and it cannot go up because every 5 years the best performer will get out of it. Right? Yes, simple.
When you say coming, what I suggest like should be that bottom up, like start selling small caps first, then mid caps or large cap if we have to sell.
First small caps, no, जब ऐसा divergence है तो.
Like
Obvious है. Micro cap, small cap, mid cap, फिर large cap बेचो.
if at all you're not selling large cap, at least sell the mid and the small caps.
Right. So this is a very classical ratio. You have to look at it, keep it, remember it. This has helped me over the last 10 years. Whenever it is below, closer to 1.1, increase small cap allocation. Whenever it is above 1.8 to 2, decrease small cap allocation. So you can use Russell 2000 and the Russell this thing also. But they don't have the bottom 15%. Again, it is Russell 2000, the top 2000 companies. So, nahi. So it is the top 2000. That's why I said this is a very beautiful index in India, which is there nowhere in the world. Bottom 15% वाला बनाया नहीं ना किसी ने. I want to meet the guy who designed this. Right? कि क्या सोचा था भाई तूने? Right? So this is a very nice chart which is always there with us. So we are right now in the middle. Right? Or at the upper end of it. So this is not the best time to buy. Not the best time to sell. Small caps. But over the next 1 year, sometime this goes to 1.8 or 2, what should you do? Decrease small cap allocation. Sell का मतलब होता है सब बेच दे. Like I said in the start. That's not done. Right? Same thing works on the opposite side. Nifty is falling slowly or going up. But your small cap is killing you. And before that also it has killed you. Right? So this is 2009. Right? Almost flat for the Nifty. What has happened to the BSE small cap? Is making newer lows. Does not work all the time. So this gave you a couple of signals in 2019. Right? There was a pop, but then the markets fell very sharply. Right? But here, then it worked out here in 2019. Small cap started outperforming, then God came to kill us via COVID. Right? So that was totally out of syllabus. But post that, again when the recovery happened, small caps have done the best. Right? So this is 2013. This was the absolute bottom of India in terms of the small cap category. Right? Where is Nifty at this price? The bottom in 2011. The small cap index has already fallen 40% in 2011. Makes another new low in 2013. Right? So out here, there is nothing here, but this is where it was like the 2007 ka opposite movement. All right. Now I'll end up with something which we do a little bit of breadth analysis, which is take all the companies listed on NSE and see what has happened from bottom to bottom. All right. So this is a chart which I've made on 24th March 2020, again public data on the website. So one of the things which I try to do is not curve fit stuff, but something which I've already spoken about in the past. All right. So this is 24th March 2020, the day of the lockdown. Look at what is the general fall? Jan 20 to March 20. 36% of the stocks had fallen more than 50%. But when you go from Jan 18, which is where the small caps topped out, the number goes crazy. 79% of the stocks are down more than 50%. 70% of the stocks are down more than 60%. Very interesting for people, those who have not seen October 8. Can you see this data point? See the comparison. Because we had some sectors like pharma and IT which did not fall more than 50%. Otherwise, the numbers were exactly like 2008 for the small caps. All. But see, small caps are the major ones which have fallen more than 50, 60, 70%. No? How many index stocks have fallen 70%? Few in March 20. What is happening? कि जैसे एक एवरेज निकालते हैं ना क्लास में कितने लोग पास हुए कितने फेल हुए टाइप्स नहीं दिस इज फॉर ऑल NSE listed stocks the full universe basically you are looking at it in Excel now this can be done on screener.in on screener.in they have something called from 52-week highs the Excel sheet comes to you so we had to write a code now we don't need to thanks to Ayush and Pratyush right so नहीं October 8 वो उधर टाइपो एरर है October 8 है वो मार्च ऊपर का है ना नहीं Jan 18 से March 2020 the whole small cap top से how bad the condition was right so the whole point to roughly do this analysis was to conclude what do we need to do see bull markets में तो कुछ करना ही नहीं है right everything works for everyone sectoral leadership will help you in what? Sideways markets. See, currently, for example, if you were in hotel stocks, you would have done relatively better, right? You were in banking stocks recently, you would have done relatively better, right? You were in auto stocks, you would have done relatively better in the last 1 year. This is a sideways market, right? And if your portfolio is up 20, 30%, that is going to happen only with sectoral leadership. So sideways market like 2011 to 13, 15, 16, 18, 20, this is where actually technical helps you a lot, right? Because you're in the leadership sector. So sideways markets are covered. Increasing cash, I've given you a very simple BSC small cap stuff. You all can go analyze yourself and you'll find it amazing, right? When to increase cash, when to deploy is opposite of it, which is basically go all in types. So these are the simple parameters, simple thumb rules. You don't need to be exactly right. Just be reasonably right around it. So that is where I end my session. Thanks a lot.